I'm very excited to be with you and your listeners today to try to give them a framework for understanding a completely different approach to markets and investing. I've been looking at markets, I can't even tell you for how long. It's more than 4 decades. And I started recently a company, QAge, after seeing so much of the information on Twitter and financial media, now X, that I felt lacked a lot of the context that a lot of new investors are experiencing with the bottom of the NASDAQ 100 in October 8th of 2002, and we were up 32 times in price since then. Some people started in 2008, some people started during COVID, but people have only seen a one directional move in technology stocks, a super expansion of innovation valuation. And I feel it's useful, and I am the most optimistic, bullish person you can find in financial media. I have targets on the other side of the winter we're expecting that I want to run through that are far in excess of every single other rational person, both for the NASDAQ, innovation companies, and even for crypto. But there's an inevitable risk of a major deleveraging event happening as we restore pricing derivative structure to a healthy level. And so my background is my first job was for a subsidiary of JP Morgan Chase, then Bear Stearns, and then a subsidiary for Citigroup and Morgan Stanley. I did work for a number of years for Stephen Cohen at SEC Capital doing research and macro. My famous claim to fame is on April 17, 2001, I spoke about the risk of an emergency rate cut happening on the same day as Cisco earnings, because we had that 26% rise in the NASDAQ on January 3rd, 2001 in just 5 minutes. So I thought there was a candidate event, and that worked out, saved a lot of risk. But I'm trying to give people a framework, both as just a listener of my podcast, someone who follows me on the X platform, someone who listens to my subscriber-only Squawk Box in the morning, where I talk about added additional insights. We're taking advisory clients. I advise a $4 billion fund, and we're considering taking assets for direct management. And so with that, I'd just like to thank you for having me here and allowing me to get a little broader audience where I can give people just an opportunity to think 1% away, divert 1% of their attention away from an existing framework. And everything they do, they can work with their advisor to incorporate it into their trading decisions.
So let's back up a second. So you talked a little bit about some of your past experiences or companies that you worked for. What were you doing for them?
So I worked.
What's your background, David? What's your background?
So my background is in credit, in forecasting, in fixed income. And then with Steve, I did a global macro, as well as it was the start of the basis trade, and just putting everything into perspective using the price level, the interaction with the derivatives of volatility and skew and kurtosis, because there's so much information that front runs prices. It's like if you have a speed limit and you know that the speed limit's going to drop, you've got to know that it's a time to slow down or you run the risk of getting a speeding ticket. In markets, when I try to give people the framework of an institution, a hedge fund, an individual investor, an algorithm, when volatility rises, it is a loud sign, take less risk. Because if volatility is low, you're supposed to put more capital at risk because there's less risk and you need more capital to get the return you want. But if volatility is rising, you need less money to get that same expected return. And one of the challenges that people have is they're told The higher the volatility, the more the return. But unfortunately, you can get whipsawed and wiped out before you get the realization of the directional benefit of all the risk that you're taking. So I want to give people a better framework for listening to the news, watching prices, reducing the viscosity or the friction of their investment decisions so that they're just not investing with their feet in concrete blocks and say, I'm going to ignore all the news. I'm going to go, I can't hear you. I can't see you. I can't speak about you. You have to recognize your capital is the most precious thing to be able to preserve help for your family, for your community, to do charity. If you're just treating it like a casino and when it gets riskier, you raise your bets, that's the antithesis what any institutional person would want to do. And that's why they're around and most investors get wiped out. So I'm trying to kind of move that information into a language and a framework that individual investors can take advantage of.
So let's start off with Bitcoin and what your thoughts are, what's been happening with it over the last couple of weeks, before let me back up a second before you start with that. What were your thoughts initially with with crypto and Bitcoin, and has that changed with what's occurred?
No, I mean, you can go to the beginning of Bitcoin, the Genesis coin, in August of 2008, I believe, when Satoshi, I can't even pronounce his name, Satoshi, he created the first 50 coins. And then it was really not meaningful until February of 2009 when the first coin hit $1. Okay. But the first transaction of Bitcoin was 5,050 Bitcoin for $5.02. That's less than a tenth of a cent per coin. That is a 1 billion% rate of return. The volatility at the very beginning of Bitcoin in its formative year or two is like the Big Bang in the universe. We had a million volatility. You go to the month of June of 2009, Bitcoin went from $8 to 30. That's 3.75 times in 1 month. You annualize that, and then you divide it by the square root of the number of days in a year, which is another way of figuring out its volatility. It's a quick and dirty way to figure out its volatility. You got a 40,000 volatility for Bitcoin. And that's why everybody loved it. You could buy it in the morning, and some days it doubled, triple that day.
Who wouldn't love
I
that,
mean,
David? Who wouldn't love that?
as long as you didn't bet at all, right, on day one. And so people were harvesting the volatility behaviorally, not by buying an option or selling an option. They were swing trading. Really below the market, they'd get hit and hit, and then it would reverse up and they'd lighten up on the way up. And it was just harvesting enormous amounts of money. But as volatility declines, and it's one of the things, it's a very complicated concept, but if you get it, it'll explain to you why Bitcoin behaves the way it does. When Bitcoin's volatility that we now have a ticker symbol for, it's DVOL. When that declines, it's effectively mathematically creating virtual coins, virtual coin supply. So when people tell you that there's only 21 million coins, that's a true statement. But they're not telling you that the system can create virtual coins just like matter and antimatter. They get excited into existence. If they're at the edge of a black hole, that will cause what they call Hawking radiation. It'll cause the black hole to decay. When we have Bitcoin going up 300% in 1 day, or in a month, let's say. It goes up a lot in a day and it starts to go up slower and slower. People get more confident selling highs and buying lows. And the range of their selling and the range of the buying has been getting tighter and tighter. And then they develop the options market in Bitcoin after IBIT. And folks, I'm not inviting you to take any look into trading Bitcoin options. What I'm trying to tell you is it's a signal about its realized price movement, which has been deteriorating. And if you look, you would notice that Bitcoin volatility had been falling. Its behavior had been narrowing and narrowing and narrowing from 2009, but in 2021, it had gotten as high as 175% volatility. Equities are typically 15, 16. Okay. That's a 1% daily move. Okay. You could get 20% daily moves, but those stopped. And the more people that were looking at Bitcoin, it's like Heisenberg's principle. The more you know the position of something, the more people looking at something, the less it can move. Nobody lets a free meal get away from them. So as the volatility was coming down, the price of Bitcoin adjusted for its volatility was getting weaker and weaker. You could, maybe we'll get some charts later, but if you looked at Bitcoin in terms of the Japanese yen got cut in half from 2013 over 10 years because they had a deflation problem. Their stock market had gone to 45% of the world's stock markets in 1989, and they're 2% of the world's population. The Japanese Emperor's Palace at one point was valued at the price of California. But Japan, in order to defeat that, they flooded the world with yen. They drove their currency down by more than half. And if someone thinks Bitcoin went up on its own because it's nice and talented and sophisticated and handsome and attractive, no, a lot of that was because the Japanese flooded the world with yen and liquidity. And then if you look at us, Bitcoin volatility is coming down, even with all that Japanese yen liquidity. And it goes from 175 down to 31.41 on August 2nd of 2023. And what happens in 2023? Powell pivots from raising rates to tighten the money supply. He goes to an easing bias because Citibank is so fragile. They're about to hit the lowest level in 4 years. We had just lost Credit Suisse. It evaporated. Their alternative tier one debt or equity, let's say, alternative tier one capital, they call them the COCO bonds. It evaporated. They weren't going to let Citibank go, so they went to an easing bias. And then we started, before you know it, cutting rates from 5 3/8. And if you look today at the March of 2027 expected Fed funds rate, it's below 3%. We don't have much left to cut. If you want to contrast a real world example, when Alan Greenspan addressed the issues of long-term capital on August 17th, 1998, and then we had the Y2K issue that no serious person was worried about. It wasn't going to make the world go crazy, but it did make everyone nervous. And if everyone wanted to pull out $500 from the bank just for emergencies, you know, what's 500 times 300 million, right? It's $150 billion. What would have happened to the banking system? Silicon Valley Bank, it would have evaporated. It'd be a run on the bank. So they put the punch bowl up and the NASDAQ rose 300% in 16 months. Nobody noticed Y2K. And then Greenspan said, I got to get this bubble out of here. It's going to distort things. He raised rates in February. He raised rates in March. The market peaks March 24th, 2000. And then he raises rates, not 25. He raised them 50 basis points on March 16th. The Treasury market, the yield curve, long-term rates fell to minus 134 versus the Fed funds rate. And the NASDAQ fell 57% in 9 months and 10 days until they did the emergency cut on January 3rd of 01. And why is that important? If the Fed doesn't cut and they let the dollar rise and they reduce the value of export earnings for tech and growth, you melt the earnings down, you melt the growth rate down, and you had a compression, what we call an innovation deflation. Those dot-com stocks deflated. Counterfactual, you can make up the story that what if Greenspan did what Powell does? Powell just cuts whenever he wants. He doesn't wait for the market to go down 50%, 57%. He doesn't wait for the yield curve to invert 134 basis points. He steepened the yield curve 180 from minus 111 up to plus 68. So he's stimulating when the market's at a very high level. And a lot of you folks out there might say, well, these companies are profitable now, and they weren't during the dot-com. Well, let's go through some of the numbers. The dot com, when Greenspan said, no mas, I got to get rid of this bubble, I got to get rid of this inflation of innovation assets, the stock market was 139% of the economy, the Buffett rule. We're 225% now. If Greenspan would have cut rates and added liquidity, the ecosystem, the innovation in dot com would have kept on going, and these companies would have been much, much more profitable before they ultimately rolled over when they lost the liquidity that flooded these assets. They're like SAP, super absorbent polymers that can take 300 times the volume of water versus a little molecule. They put them in bags and they put them at levees when there's a flood zone just to absorb the water. But the water leaks out. So the NASDAQ went from um, uh, 2 trillion to 6 trillion on March 24th, 2000. And Greenspan let it fall by 5/6 down to 1 trillion. And if you think about it, if you would have invested at the peak, you would have gone from a 4,800 on the NASDAQ up to 25,000. The NASDAQ QQQ symbol went to 120.50 before it went to 52.17 when he did the emergency cut. And then it went all the way down to below $20 from 120 to 20. If you would have invested at the top, you'd have 5 to 6 times your money. If you invested on the bottom, you'd have 32 times your money. Nobody buys that. Nobody sells at the high. Nobody buys at the low. That's not the point. But if markets are cresting and they're getting exhausted and they're just unsupportable, you're losing the added liquidity from the policymakers, whether it's debt, whether it's deficit spending, whether it's rate cuts, whether it's currency weakening. If you start losing that, it's easier to get out on the way up and get out on the way down. Amazon fell 95% in 2 years. $100 went to a nickel. No one's selling at 100 or buying at a nickel. No one's getting 20 times the shares. But if you're starting to see, just an example, Nvidia, it's 5 trillion, the biggest of all. It's 16% of the US economy, right? 5 trillion Nvidia, 30 trillion economy. Relative to the world economy, it's like 5% of the world economy, 4.5% of the world economy. Cisco peaked at 1.6. If they would have cut rates, if Greenspan would have cut rates and made money more available and not deprived lenders and the ecosystem, it would have gone up. It would have kept on going up. The liquidity creates the opportunity. The liquidity creates an extension of a cyclical wavelength. Ever since we got off the gold standard in August 15th, 1971, under Nixon, he took us out of Bretton Woods. We devalued the debt. We debased the dollar. Gold was 35. It went to 4,200, 4,400. Because when you debase the debt, when you debase the currency, you don't have to pay that back with the same dollars. You pay it back with worse dollars. It's very easy. And the more they introduce money out of Japan to get rid of their deflation, then the COVID spending, the COVID easing, the COVID deficits, it's an ocean of liquidity. That's not continuing at the same rate. So if you look at a price of Bitcoin, you say, well, relative to the dollar, it's gone from a tenth of a cent up to 125,000. It's 126, but the numbers are easy to remember if you do it in rounder numbers. It went up 9 decimals with a reservoir of liquidity out of Japan. And if you look at Bitcoin in terms of yen, it's unchanged. It's barely up since 2000, since COVID. It peaked at 64, but the yen gets chopped. And in yen terms, so you're getting all this liquidity in the system, but it's ending. Powell has very little room left. He's already below 3. The last 1.5 has effectively no effect on stimulant because you're causing so much mortgage refinancing activity, and you're taking the mortgages off of the balance sheets of banks and replacing fixed 30-year mortgages with a lot of these adjustable rates, so they're not earning as much money. And a bank takes every dollar it earns and turns it into $10 of loans. We have a transition now after the global financial crisis, which I wanted to go over later, why we won't go into a global financial crisis 2.0. We have the greatest amount of equity in stocks, the greatest amount of equity in housing. Those are shock absorbers. And now we don't have to worry about Fannie Mae and JP Morgan shutting off the valve and saying, oh, you can refinance, but I want 40%, 30% down payment. In other words, your cushion. I'm not just letting everyone out of their high mortgage. And then as the economy slowed, as inflation fell apart, we lost 7.7% of inflation in just 13 months. June of 2008, 5.6. July, a year later, negative 2.1. So that your income isn't keeping pace with your mortgage payments. So you cut back on everything: Netflix, Starbucks, Dunkin' Donuts, going out to dinners. And all those businesses laid people off. But right now we have the independent mortgage brokers, the top two, again, not advice, Rocket and United. They're they're 10 times the size of JP Morgan's origination. And they're messaging people every day by AI bot. Let us refinance. Let us send your money through a mortgage-backed security pass-through that that Trump invented in January 3rd of 2019. That was when it was approved under his last administration, so that you could package a bunch of mortgages and send them off to an end user, and they're going to be leveraged one or two times versus a bank that has 10 times the leverage. I just want to introduce the concept of American exceptionalism. Most of Europe, international, they get 87% of all of their credit from their banks, which are levered, fragile institutions, which are very dependent on the shape of the yield curve and economic cycles. In America, we have disintermediated. We have disintermediated 75% of our lending function to private credit. And I'm not talking about the leveraged guys like KKR and Apollo. I'm talking about just traditional, you can borrow money through not using the bank for places that don't leverage up very much. And then we have independent mortgage brokers for our housing. So America's become so much more resilient than every other place in the world because we don't have the lending function dependent on the shape of the yield curve that the Fed would cut rates, steepen the yield curve to repump out credit. It's not like that anymore. Lower rates are going to create a huge economic boom in America. We have 35 trillion of home equity. We have 14 billion at the beginning of the GFC, 8 trillion by the time that thing got worked out. And now you don't have Fannie Mae saying, I'm bankrupt, I can't lend you any money. You don't have JP Morgan saying, sorry, I'll need 30 to 40% leverage, capital, down payment, or or conformity. You have to have 20%. They raised that to 30 and 40. So nobody could get money. Only the rich could get money. So now, where are we? We have a Bitcoin that sucked up all this ocean of capital as the volume of capital exploded and accelerated. And now we're in an environment where the market's calling the bluff. The Fed can only go to zero in America. Unlike places around the world, we have 7 trillion of money markets. They won't function in a negative rate environment. So Bitcoin is coming back to earth. And when you have people and they give you these charts, these two-dimensional charts priced through time, and they say, look, we have 3 drawdowns of 80. They're not giving you the kind of charts we generate. 3-dimensional, 4-dimensional, 5-dimensional, 6-dimensional charts. It's like